Major funding for these broadcasts has been provided by grants from New York Community Bank, M&T Bank, PBM, Customers Bank, Collins Building Services, AmTrust Title Insurance Company, Marks Paneth, Capital One Bank. Additional funding for these broadcasts has been provided by grants from Amerant Bank, Bank of America, Citizens Bank, Dime Community Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC Handler Real Estate Organization, Hodges Ward Elliott Inc., Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Catsimatidis Red Apple Group, Keysight Capital Partners, New Banks, Meridian Capital Group, Ocean First Bank, People's United Bank, RPW Group, TD Bank, and these friends. Is there money out there for real estate? People are happy, vaccines are working, things are coming back to normal. But what's coming back with regard to real estate? Okay, how's real estate reacting? And how are lenders, the individuals who have to put out the money, operating in this post-pandemic era? So today I've assembled these group of banking executives to provide their insight. My guests include Matt Petrillo, Group Vice President, M&T Bank, Ben Stacks, Executive Vice President, Commercial Real Estate, Bank United. And last but not least, Phil Watkins, Executive Vice President and Head of Commercial Real Estate for Customers Bank. So I believe that, Ben, you're the senior citizen over here next to me, okay, or Matt. How have we seen this cycle today as we compare it to 2008, compared to 2001? How do we see it today? How are we coming out of it?
This is unlike anything we've ever seen. I personally am struck with how quickly things seem to have turned around. If you go back, 12, 15 months, people could have painted a lot of pictures that were really grim. And I think we were all really worried. I personally am surprised at how quickly things seem to have turned themselves around. And in particular, things here in New York just seem to be, really starting to run very fast. So I'm encouraged by this. I'm really optimistic. And boy, what a difference a year makes.
Yeah, but the question is, are we back to business as normal? Different asset classes, if you read the rags and the other information, office space is still available for sublease. It's the highest number of office square foot available. It's a tough time to make lending on office. The question of the condo market, the All Shan report says things are good over $4 million. Properties are leasing over there. And then you talk about the hospitality market. I believe, Ben, you have a major influence in Florida. The hotel occupancy was close to 75%. But if you take the hotel occupancy in New York, you're probably lucky to be at 40, 45%. So I think it's a tale of different cities in different parts of the country with regard to that. Phil, let's talk about customers, because you've been expanding and you just recently opened up 2 new locations around the country.
You hit it very well that it's very difficult to paint the entire real estate industry with a broad brush. I would definitely agree that the recovery has been, broadly much faster, I think, than many expected when it was going in. But obviously, asset classes like multifamily, have held up much stronger than office and hospitality and certain types of retail. But again, even within those asset classes, leisure drive time hotels seem to be performing much better than say your your downtown conference industry type hotels. So you really have to drill into the specifics. But as you said as well, markets are not equal. So, we've recently opened up offices in Texas and Florida. And when you look there across most asset classes, you've really had no declines. And in fact, in many fundamental indicators are stronger than they were from a pre-pandemic basis. So I think we're definitely bullish on those higher growth markets. But I think we similarly are very optimistic at some of what we're seeing from the recovery in New York City, and hopefully much faster, from a lot of the research and projections we're seeing than even, after the GFC, where it took about 2.5 years.
Matt, M&T has a major influence, and I know it was just approved, the acquisition of, People's United. What's the bank's philosophy today with regard to entertaining new real estate transactions?
Our philosophy really is the same as it's always been, which is to serve our good customers and certainly welcome people's customers, which is going to be tremendously synergistic for the company and as we expand our footprint. And our outlook is positive. We're thrilled with the speed of the recovery in the last few months. Speaking with a couple of clients just today, and the pace of residential leasing, for example, multifamily leasing in New York, which really picked up around year end and going into the first quarter. The last 6 weeks, the quote was, the last 6 weeks has seen more leasing than the last 6 months. And concessions are down. Buildings that were offering 2 months concession are offering 1 month, or in some cases 0. Occupancy is is consistently above 90%, with some buildings as high as 97% again. So that's really strong. I think the thing that's lagging right now is still office, and it seems that landlords are working to determine what their employees' needs and how their employees are going to use their space as they return to the office before they make new leasing decisions. But the market certainly feels vibrant, and the change in season certainly, I think, does a lot to help the psyche as well. So we're bullish, and we're excited to serve our customers and add new customers.
When we talk about the office, as I was just bringing up, people are saying that the A buildings is still doing well. The ones that are really hurting are the B and C buildings, the older buildings who have situations over there. I mean, have you underwritten any new deals in the B and C office market?
For M&T, we've not seen a huge number of transactions, mostly refinances as of late. So hard to comment. We did a good size refinance Midtown South a few months ago. And, underwriting is pretty similar to what it was. I think, we're certainly sensitized rents down a little bit, probably, I don't know, on the order of 20% or so from where we were previously, though we were never really underwriting in cases where we perceived it to be top of the market rents. We were always sort of sensitizing a bit anyway. So
I would agree with Matt. I mean, we just haven't seen a lot of transactions, but and so, I think to the extent that we have stuff that we wanted to keep, we would certainly be interested in refinancing it. And, we would try to, take as much into consideration in the underwriting as we possibly could. But I think the reality is, especially with respect to office and especially in New York, or at least, many of the major CBDs around the country, we just don't know what the ultimate effects of this are going to be. I mean, our company in particular, we're starting our return to office process this coming Monday. And as we were talking about before we started filming, that's going to mean a lot of different things. I mean, it's going to, I think, again, here in New York will mean a slow, repopulation of the offices, people getting used to, getting on the subway or the bus or the train. I think there's a lot of things that we forgot over the last 15 months, the things that we were very, also very kind of scared about that happened. And it's been a very stunning kind of 15 months here of, horrible things. And I think it takes time, as with any kind of trauma that you go through, to try to, get back to some semblance of normal. And I think that really applies to the office market, where pre-pandemic, and certainly for the past, say 3 to 5 years, there has been at least some densification efforts in offices where companies are trying to make more efficient use of space by putting more employees in smaller spaces and smaller square footage allocations. That slowed down a bit pre-pandemic, but still, I think the trend was really to try to densify space and get more efficiency out of it. That has been completely turned on its head. And I think, we just have to see how all this is going to work. Yes, there's a ton of sublease space on the market. I think that's certainly a worrisome trend. But also I think that the office, functions in a really important way in business that can't be replicated on Zoom. I mean, we can talk about the virtues or not of Zoom. I mean, it's wonderful that we can all sit here and do this in the safety of our own homes or offices, but there's no replacement for getting out and seeing customers and spending time with other colleagues, even being in the office, where, you're walking down the hallway and say, oh, I had this idea, and I go over to, Bob's office to talk to him about it. I mean, it just, this is such an antiseptic environment on Zoom, and it really doesn't lend itself to collaboration or efficiency or anything like that. So I think there's this pull that will bring people back to the office, but I also don't think it's going to be the same.
If you want to build a business relationship, it's really difficult to do it by a virtual meeting. I think, there's body language, there's talk and touch over there. I think it's really very, very difficult to do that. And especially, Phil, as you just mentioned, you opening up in Texas and you're opening up in Florida. If you're going to new markets, you have to be there on the ground. I don't think you can do this over there. And I think real estate, it's an asset that you want to see. You want to physically see the neighborhood. You want to see what's going on over there. And I think that's an important virtue. One topic, that everybody has always been scared about besides the hospitality is the topic of retail. How do you look at retail today? Because, if you walk around Midtown, you see some of the restaurants packed, probably busier than they've ever been because of the outside seating. But how do you see that, the retail market?
High street retail really depended a lot on whether it was that neighborhood use retail. Some of the restaurants in locally driven area, neighborhood driven areas that I think, as you said, Michael, are in some cases ones that survived or seeing benefits. But you differentiate that from some of the corridors in Soho, Madison Avenue, Fifth Avenue, where stores were really, calling it marketing dollars, right? And they were spending, very, very large sums of money on very high escalated rents. And you saw that start to come down even pre-pandemic. Those rent levels were falling dramatically because they just couldn't continue to justify that and replace the stores. So, I think that's going to be a trend that you probably see continue. Again, I don't think high street retail is going away. It certainly continues to serve a function there. I think it just couldn't justify the sort of astronomical rents that were happening in some of those corridors. Candidly, at customers, retail is just not an asset class that we've focused on, significantly. Our retail exposure has just been very, very low. And so as a result, we were very happy and fortunate that, during the pandemic, but I don't think we're necessarily changing our outlook on that. We do it very selectively for, either a very specific transaction or a customer, serving a customer, but by and large, it's not an asset class we look at a lot.
Matt?
Yeah, I agree with Philip. We do have a decent sized retail portfolio. Most of it is, at least in New York, is urban retail, ground floor of buildings. We have some high street exposure. And then outside of it, we really have as a company, no regional mall exposure really. I think, you know, like Philip said, I don't see any of it going away. Certainly, it's changing, and the growth in retail rents between, you know, call it 2010 or so and 2015, 16 was on the order of 100% in some of these high street locations. That's, you know, we can't expect that we're going to get back there. And today, you know, we're certainly high street is down probably 50%. And I've heard anecdotes where it's even more in certain locations. And the idea that you can justify a loss leader location just simply so that you can put it on your shopping bags or have a flagship, it just doesn't seem to exist anymore. As we look back, you know, it kind of feels like maybe that was an unsustainable thing, and that's kind of proven out now. The only other thing I'll add is we're hearing some green shoots in the sense of hyper-local fulfillment centers leasing some locations in New York that were former retail locations. These will sort of take use of almost like a mini warehouse, allowing for, like, you know, hyper-local, last few block type of fulfillment for you know, deliveries in real time. That's a nice a nice positive happening in retail, although they're certainly not paying the rents that we once saw.
I think the bigger issue for New York was that, and Matt touched on it, that the retail rents really ran away from some more fundamental concepts in the period kind of leading up to 15, 16, and you know, and I think there were probably some unrealistic expectations about continued rent growth and you know, continued demand in the face of, you know, let's be frank, the whole Amazon effect that's been around for quite a while. You know, in a previous life, we did a big study about the effects of Amazon and other, you know, internet influences on retail. And you know, we never ended up, excuse me, with any kind of positive effect on you know, brick and mortar. I mean, the only kind of saving grace for brick and mortar was the omni-channel retailers that, you know, figured out how to kind of navigate, you know, all different channels of sales, and you know, you still see that going on. I mean, you know, Peloton started as online only. They went into stores. Warby Parker did the same thing. They went into stores. You know, now even I see that Google is opening up a store at 111 8th Avenue. So, I mean, I think that, you know, fundamentally, you know, companies still like the retail environment to be able to connect with people. And I think in the future, the personal connection will be, you know, a huge driver of sales. And, you know, you can buy, you know, toilet paper and paper towels online, you know, or a whole bunch of other things that you don't really need to go to the store for. But, you know, you're not going to spend $2,000 for a Peloton unless you can go sit on it and talk to a salesperson in the store. So I think all this stuff is changing. And I would note that the dichotomy between the retail exposure we had in New York and the retail exposure we have in Florida through the pandemic has been stunning and stark. I mean, the retail properties in Florida that we had just, you know, they were doing well pre-pandemic, and they certainly continued throughout. By and large, it did really well. And I think part of that is to part of Matt's point, which is, you know, in New York, retail rents were really kind of running away from fundamentals. In Florida, they really didn't change that much. That tells me too that there continues to be demand for traditional brick and mortar retail, but it's going to be less over time. So I think just kind of going forward, it's definitely something to be careful of, and you definitely have to pick your spots with the right sponsors.
Here's a two-pronged question, and specifically for Phil and Matt and Ben to answer it also. Private equity firms, private lenders have become major players in the market. And some of you are doing something called node-on-node financing. So let's talk about private equity and what you're doing, Phil, specifically with node-on-node financing.
It's well documented that even, you know, coming out of the the GFC, there was an increasing share of private, private capital filling a lot of the debt stack. Some of it was by design, right, coming out of some of the increased regulation and lower risk tolerance that came about after 2008. And I think, generally, I think it's a healthy thing for banks. How we viewed that, rather than sort of a competition of is private capital stealing, a portion of the pie available for banks. We viewed it as a partnership to fill capital stacks. And so what we've seen is, as banks across the board came up with lower leverage levels out of the crisis, which again, I think is a good fact pattern. There are two ways to fill that gap as an equity investor or developer, or I guess three ways: either come up with more equity, put mezzanine financing in behind that lower leverage bank financing, or really move towards where we've seen a lot of growth is the private funds providing whole loans. So sort of stretch senior loans that get up to that additional capital that developers need. And then we provide leverage to those debt funds, obviously in a senior position on a lower basis using a note-on-note financing structure. And we found it to be a very attractive product for us to get good risk-adjusted returns, we think, at leverage levels we like. We're lending to sort of top quality sponsors, usually multi-billion-dollar debt funds, that also have the ability, if there are bumps in the road, to work with the underlying developers. And we're able to maintain a sort of current and healthy position loan. And so we've seen it as a really strong growth area, both bridge loans, land loans, and a big part of our construction financing, underlying construction financing has been through this product. And kind of going to the markets, I mean, we're doing some in New York, but we've seen a lot of activity in Florida and Texas, where really a lot of the, strong, as well as some markets across the Southwest and West, where a lot of the, strong development projects are popping up.
Matt?
Yeah, we're probably a little more old-fashioned than Phil. We prefer to have a seat at the table with the end user of the real estate. And so, but that means that there's a stretch situation. So rather than note on note, which we've done here or there as a, as a private banking type of an accommodative structure, typically it would take the form of as Phil said, like an A note, B note situation, or rather senior and mezz. Maybe have someone in behind us to take a first loss position. But it is important to us that we have a seat at the table with the end user of the real estate, and that it's a part of a broader relationship.
Just from our perspective, we would do that structure more in a corporate facility kind of construct, where we're going after the entity that is doing the lending, and we have a direct relationship with the entity, and whether they made a direct loan or they're, say originating, agency paper or something like that, we would go to the entity and structure something where we take a basket of notes as collateral for a credit facility to that company. So as opposed to being, specifically on an asset by asset basis, we prefer to be at a, upper tier credit risk with the entity, taking the notes as collateral. Yes, I think there's some room for that. Certainly the proliferation and success of the debt funds, maybe we can talk about that too, is pretty impressive, and they're certainly very active, and I think there's a lot of opportunities because of their activity that are coming to lenders like the three of us. So it's definitely something that we're doing and looking at looking to do more of in the future.
So here's the question: what do you see, with the return to office and other things taking place? When do you see the market adjusting, to a level that not happy days are here again, but happy days are coming sooner than later? Is it 6 months from now? Is it after Labor Day, or is it we have to wait till 2022?
It's a process that's just beginning, and maybe we'll see some more of a bump at the end, around Labor Day, where companies are calling their employees back to the office. Some semblance of normal probably happens in mid-22 would be my guess. So it's going to take some time to come back.
We need tourism back too, right? And so it's not just the Midtown folks or the commuters or the folks occupying office buildings. It's the fuller return of, you know, domestic and international travelers. That's really, to me, the bellwether. And to that end, I don't really see that happening until next year. You know, to kind of get fully back to normal, if that's what you want to call it. So I think that's the last and biggest potentially key component of the full recovery.
I think we need tourists coming back, but I also think we need students coming back because many apartments are occupied by students. We need foreign investors to come back who want to take advantage of, let's say, the 8% or 10% discount plus closing costs on condominiums. And I think, you know, things will get a little better, but it's going to take time. And I think one thing that I didn't bring up, and I just want to end it shortly, is safety. Okay, we need safety in the city of New York and around the country, so people will feel comfortable buying property, operating properties, going around. And I'd like to thank all three of you, Phil, Matt, and Ben, and I'll see you next week.